Hey everybody, good afternoon. Welcome to 12-Minute Trading. My name is Doc Severson. I am joined by Dave Lukas over here of 12-Minute Trading as well. Today is Monday, the 13th of January in 2025. And boy, it's been a hell of a beginning to the year. We had a good first week, and then the last week has been utter destruction, but there
Yeah.
may be a silver lining in this. We'll see if we can find one in today's market. So the big issue is interest rates, right? Interest rates. So inflation, where we think we whipped inflation now, it's not been the case. It's recovering, and this all
Yep.
started with the Fed meeting from last month, and
Yep.
almost a month ago, Fed meeting where Powell was basically saying they changed the dot plot. That's what they did.
Mhm.
Is that so we're expecting fewer rate cuts in 2025. And now I think the way the dot plot looks, we'll be lucky to get one by the end of the year. So
Right.
that has been a big disappointment for the market. Market doesn't necessarily hate higher rates, but it's the pace of those rate hikes or pace of the inflation that's going higher, the pace of the yield rise that is unsettling things. That's always the case. That was the case back in 22, and it's happening
Mhm.
once again. So with that in mind, we're going to have a little bit of a discussion in terms of how this compares to the beginning of 2022, 3 years ago, where we truly went into a full-on bear market. But Dave, what are you seeing out there, man?
Well, we have, as of now, today, we dipped below, but we have held that 5,800 level on the S&P 500, which, for those of you, and we'll get into the charts in a minute, I've been talking about as the kind of the key level. That's that moving average on the weekly chart that continues to hold during a bull market, right? And is typically your line in the sand when it gets crossed and then cannot get back above it. You typically are shifting into more of that bear market. Now, we have definitely over the last month transformed into a more sideways and volatile market, right? A corrective market. And that's why we get these wild swings up 90 points one day, down 90 points the next, and so on. And so the market doesn't know where to go, right? And remember how what is the underlying of the market? The underlying of the market is earnings, but it also is forward looking. It's also trading off what it thinks the future is going to be. Well, you got a dollar that's extremely strong. You got rates approaching 10-year is approaching 5% again. And remember, the Fed doesn't control the long end of the curve. The Fed doesn't control the 10-year. The Fed doesn't control the 30-year, and that is a true market, right? And it's the market. It's the biggest market in the world. And so what the bond market is saying is that it expects higher interest rates. And you guys can think about this, right? Think about what's going on. $15 trillion in the span of about 6 to 8 years have been added to the US debt, right? And so if you are in that place, right, if you are somebody who is effectively loaning the United States money, right, and you see the Fed cutting rates, right, into what is actually seems to be a fairly strong economy. We just had jobs numbers blow it out last week again, right? Whether you believe them or not, it's a different story for today. But think about it. Locking your money up for 1 to 2 years, not so big deal. That's why the short end doesn't move as much, and the Fed controls the short end with cutting rates and that sort of thing. But that long end, if I'm going to lock my money up for 10 years, you could be at 70 trillion in debt, 80 trillion by the time I get through 10 years. I want more for my money for that risk because who knows, right? And that's kind of what we're seeing, right? So that's a little bit of it. And the bond market is kind of sniffing that out, right? Because the Fed the Fed moved, and I don't know if it was because of the election or whatever it was, but a 50 basis point cut, and then to do what they've done is it doesn't make really much sense. It seems very erratic and helter skelter to go from dovish to all of a sudden hawkish within the span of 3 or 4 months, right? And if the rates keep rising, the fear is that the Fed's going to have to raise rates again, right? And that's kind of what's got the market on edge. You got a new administration taking over, right? And remember, this is the last point, we get into the charts. Remember also, part of what's made this market what it is that we've seen is a lot of money printing and a lot of debt spending. Debt, 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 right? So what happens if a new administration comes in and gets fiscally responsible and takes that punch bowl away, right? Now you got a double whammy, right? Now you got the punch bowl getting taken away, but you also got rates up, you got the dollar up, you got all that. So the market doesn't know what to do right now. And that's what we're seeing in the market. I think tomorrow's CPI number is going to be one of the most important numbers of the, of for us right now, because I think it's going to kick off the next trend either way. If that thing comes in hot, this market is going to sell off big time. If that thing comes, under or in line, you might see the market stabilize here and everything, because it makes it less likely the Fed will raise rates again. I think that's the bigger fear. So from a macro standpoint, guys, that's what's going on. We can take a look at the charts and talk what price is telling us. So go ahead, Doc.
Well, just a couple of things here. First of all, we always talk about this, the fact of the Fed is always way too late. The Fed was way too late to start tightening things up, because after,
Yep.
16 years or so, there was a certain amount of momentum that kept things down. And they were very quick to sort of say, it's transitory, because they saw what they wanted to see. And then all of a sudden it was like, oh crap, it's not transitory. And that's what shocked the market back in 22, is that they had to go into full-on rate raising cycle.
Right.
So that was difficult for the market. And then by the same token, we've been seeing inflation drop. Last year, we saw inflation drop very quickly, and the Fed was holding off for too long, trying to keep, we don't want to react to this. We want to make sure. And of course, they were way too late in their cutting cycle. And now, now they've painted themselves into a corner. It's kind of crazy. And
if you look at it from that perspective, where they've got rates, short-term rates, which is what they control, are still higher for the most part than what inflation is, right? So usually those are supposed to come in line, right? Inflation's at 2.6%, right? Then your rates should be coming down to that level, right? So that's part of it too, but it is a mess, guys. I mean, with that much debt and everything else and stuff, this is going to be the new kind of norm. These kind of weird cycles dealing with this stuff. And typically, yes, in the past, when there's been big inflation spikes, like what we saw, 20% plus inflation within the span of a few years, once they think it gets under control and comes down, it spikes again. Throughout history, that's kind of what we've seen and everything. So there's, looking back at the 70s and that sort of thing, it's a very similar type of, we had that reprieve for like a year, and then all of a sudden it starts up again. So that's why I'm saying tomorrow's CPI number, it could be the nail in the coffin, right? I think this market is on an edge, it's on a precipice, and it's either that hot CPI, it's gone, right? Just over the cliff we go. That CPI number comes in light. Oh, okay, things aren't as bad as we think. Everybody piles back in, and you get massive movement. And the weekly chart's set up for that. It's at the highest charge level that it's been in 5 years. So there's a multi-month move in either direction.
Let's talk about that for a second, because we've got actually tomorrow's PPI. And
PPI. CPI on Wednesday.
The PPI from a month ago came in a little bit hot. CPI was in line. PPI came in hot. And so what they're looking for tomorrow is consensus month to month 0.3. And then year to year is consensus 3.3, because that takes into effect last month's slightly hot number. So we're going to be watching these numbers very carefully. And of course, there's going to be all kinds of algorithms.
Yeah, what's the CPI final demand?
Now, the CPI comes in on Wednesday. And right now, prior and consensus is going to be 0.3 month to month. So 2.7 last month, 2.9 year to year versus last year at this point. So getting far away from the Fed's 2% target number. So we'll anyway. So that's what's going on tomorrow. And then if we look at if we look at the charts, which are somewhere around here, there we go. Okay, so what we're going to see tomorrow?
I love looking at YouTube through
Through
YouTube.
YouTube, talking to YouTube, talking to YouTube. Yeah, it's like an infinite loop here. So this is the issue that Dave's talking about is like rates. This is the 10-year note. The rates being at 4.8%. It's not necessarily, if you look at this from like a weekly chart and we go back in time, it's not that rates being high, because if you remember, at the end of 23, we had one hell of a rally into the end of 23.
Mm-hmm.
And so it's not the fact that rates going higher is necessarily bad for the market. It's the rate of change. It's the fact of like, oh crap, we gotta catch up really fast, and that is what upsets the market. Now, longer term, this is the problem that I think there is. If you look at this, does this look like a bullish chart or does this look like a bearish chart? Forget about what this is. Just look at the chart itself. And if you know anything about chart patterns, this is what's called the bull flag, right? So this is a consolidation in the middle of an uptrend. And in fact, it is taken away the former downtrend, which goes all the way back to 07, 08. So we've been in an era of declining rates, including the COVID. And that was, the pandemic low was the low. And then since then, we've had nothing but spending. So that is the encapsulation of one administration, which is on its way out, is going from these levels of long-term notes to this now, almost 5%. So that's what's rocking the market. So Dave was bringing up, looking at, let's see if I can find Dave's favorite chart here. So we're going to go to the S&P. Now the S&P is pushing down on the lower Bollinger Band on the daily chart. We are seeing, for those of you that recognize this is positive divergence. So as we're making new lows, we do have positive divergence on the MACD histogram.
Mm-hmm.
Now, Dave likes to look at the weekly chart, and so we're just below that. We're just below that moving average on the weekly chart. But, we'll see whether we reclaim that by the end of the week. That's going to be the big battle there. You can see there when I zoom in on it, that's the move. That's a 20-period moving average, which is...
And we are squarely below it now.
Yeah.
So even coming back some today. And that traditionally, if you zoom out, is the kind of the break line, between bull and bear markets. If it can't recover it, right, and we got a whole week to go, right? So it can easily recover it by end of the week. But if it goes and closes below it and can't recover it again, then you typically are flipping that change in character and headed down lower.
Yes.
And right now we've got this thing charged up beyond belief with the energies. The highest charge I've seen in about 5 years on this thing.
Okay, so what Dave's talking about there is if we go out to the fractals and if we look at what's going on here, we have a massively charged up weekly chart. So this is actually starting to burn some energy in the downside direction.
Mm-hmm.
And so across all time frames, we have huge potential for this to charge up or to actually to move. Now, I hear a lot of people out there talking about potential head and shoulders showing up here. You can see whatever pattern that you want to see in there. A lot of times I've seen these head and shoulders show up and then we see an undercut under the trend line. We get everybody leaning bearish and then this thing just explodes like this. That kind of goes back to what I was saying a couple of weeks ago as to in terms of what I'd like to see. I'd like to see everybody get really super negative today and then get blown out. The PPI is going to be the first number. It is the least important of the two inflation numbers. The consumer price index is more important, but it is what it is. We get the PPI.
If it comes in hot, though, people are going to trade ahead of the CPI, thinking that's going to be hot too.
Right.
They don't always the same, but they have lately ran more together.
Right. The market will react off of the first report that it gets, so it will react tomorrow morning. So
And look
Speaking
at
of,
that charge on that weekly chart, guys. When we're charged up 60, which is this thing was above 60, it was like 67, and it has started lower. Like you're talking 54, 5,500 if it wants to go down to there.
yeah. So
And
what?
if it does go down, it's going to happen quickly, guys. Remember, the bull climbs the stairs, the bear goes out the window. So when in doubt, palms out, right? So when things, there's a reason those sayings have held true over the years. When everybody starts selling, it's on, right? And it's
Yeah,
going to crash very quick. Could be like a 200 handle day on the S&P.
yeah.
You could get.
You'll never catch it in time. It's you got to be in
Yep.
it to win it for these things. So
Yep.
let's see. I'm going to remove the fibs from here. Now, what I want you to watch is that this is the ES, and so we've got some important levels on here. So we've got some upside gaps. These are gaps to the downside. We have a downside gap which got touched today. So
Mm-hmm.
it's almost tangling with a downside gap. We almost have the price down to the 200-day moving average, which
Yep.
is very important support. And then just below that is going to be a full 10% correction. So I don't know exactly what we dropped to today, but it looks like just eyeballing it, it looks to be between
Mm-hmm.
6 and 7%. So we're getting to the point of getting the negativity up there. What we're also starting to see is if we go out to ATR, average true
Mm-hmm.
range, we are starting to see 74 handles a day. So this
That's
is
pretty big.
yeah. I mean, if you consider that during the 22 bear market, we got up to about 100 handles a day, and generally during bulls, we in August we got up to almost 100 again,
Mm-hmm.
and all that was just a pullback. Didn't
Yep.
feel like it at the time. It felt like the beginning of a bear market, as does this one,
Mm-hmm.
right? It feels like that, but we're seeing the same kind of things here. Now,
Yeah, and
something else.
again, the weekly chart's the key to this thing, and I think we're gonna know by the end of this week, beginning of next. And I think CPI is your catalyst. I mean, maybe PPI kicks it off, but I think CPI ultimately is the catalyst. Um, and it's a lot easier to sell out if you're unsure, right? In fact, my students know, like last end of last week, I said, "Why are we messing with this? We got just a few positions on. Let's just clear the decks and wait for this thing to tell us which way it wants to go."
Yeah,
And so we did that, right? And so that's right now the key to this. Everything is patience, and it's the hardest thing to do in trading, right? You got money sitting there, you want to put it to work, and so on. But gosh, you can hit your profit target for the year if you're just patient enough and let this unfold and then take advantage either way it goes, right? And so that's kind of how I'm preparing for this. I'm honestly at this point, I hate to say this, I would love a 10 to 15% correction. I would absolutely love it because we get it out of the way, and then the rest of the year we'd probably grind higher. And you could for us as option sellers, the premium spike you'll get in options, the ability to sell so far out of the money, right? And take advantage of that. It's a great way to start a year, honestly, because you can make a lot of those profits you want to make in the first quarter or two, and then ride the wave through the rest of the year. So. But you got to take what it gives you. So again, which way do we go? That energy in that weekly chart is 300 to 400 points in either direction at this point. So, and
yeah,
on the Nasdaq, it's 2 to 3,000 points, right on the NDX. So just to give you an idea.
yeah. The Nasdaq is really not in that bad a shape. I mean, if we look at things, I mean, it's
Mhm.
I mean, it's a very shallow downtrend, though. It's a very shallow
Mhm.
downtrend. I mean, if we look at this through the lens of kind of zooming out, that's a swing test that we're seeing here at about 20,600
Yep.
on the NDX. So that's very normal, and it's just taking its time to go down there. Now, what I've noticed about these types of moves is that when we get these downtrends that are like this, if we look at this through the lens of kind of a descending wedge pattern,
Mhm.
this is typically a bull flag, right? So we
Yeah.
are looking at a longer term bullish formation. And
Yeah.
what I like to see is that if you look at descending patterns, this is rule number 3 in fractal energy trading. Descending patterns will eventually break to the
Right. Yeah.
upside. But
Yeah.
one thing I'd like to point out to you guys is that what I've seen is that descending patterns typically do not reverse until they squirt through the bottom trend line, which is what nobody's expecting. And then that's when
Mhm.
they, so if we get a nasty catalyst, a bad print, that's exactly what can happen. Now, one thing to keep in mind, let's go back a year. Let's see, the very, and I think I brought this up last time. This date here on 10/13, this candle
Mhm.
here, which is a massive reversal candle, so you can
Yep.
see how it actually drove down lower and closed much higher. That
Yep.
was the CPI. That was a bad print on the CPI. But what the market did was to say, you know what, that's a really nasty number. It's probably the worst one that we're going to see. And they started buying from that point. So that was the very
And,
bottom of the bull of the bear market in 2022.
and you find this with markets too. Over the, doing this all as long as we have, all the market needs is the excuse to go the way it wants to go,
Yeah.
And so like again, I don't know if they'll see a higher CPI as a catalyst, or if it's in line. Oh, that's great, right? Let's off to the races. But there's just typically where you know when everybody's on one side of a trade, it's going to go the opposite direction. So if everybody's now positioned bearish going into CPI, better chance for it to run the other way, you know? So that's kind of the thing is like I don't want to who wants to mess with that? Like in our world, let it happen. Let's see what's going to happen, which way
Right.
it's going to go and take advantage of it, right? It's
Right.
a nice thing about selling options. I don't have to be right? I don't have to try to pick the direction and just let it unfold. So the other thing, Doc, though, to bring up, this could be interesting because we've seen this before as a leading indicator, right? Our good old canary in the coal mine. Pull up the chart of the Russell and look at the weekly chart and the daily chart.
Russell has come down to the 200. I'm assuming you want me to look at this on the Bollingers.
Look at what the fractals.
Okay. Okay, Russell on the fractals. We have, I mean, this overall is a great big rounded base setting up with a potential handle pattern. So that's one thing
Mhm.
to look at. Now we are eating energy to the downside on the weekly chart. This was fully charged up. It has decided to go to the downside. We're also seeing some energy leakage to the downside as well too. But
Yeah.
finding some support at the 200-day moving average. To me, the bigger picture here is the handle formation. So it may
Yep.
just for weeks trade within the range of 22 to
Mhm.
2400.
And that's the thing. Like the Russell many times is kind of the canary in the coal mine. Like it leads the rest of the market, and the reason it does is because these smaller companies, it's harder for the fund manager, somebody's moving a lot of shares to unwind out of a position in these stocks without getting seen and noticed. If you notice, like last week, and this is a telltale sign that the big guys are dumping, we would spike up in the early part of the day and then it would sell off into close, right? Those are volume spikes that the big players are looking for, and then they're unloading their shares and it's dumping into the afternoon. They can't do that with the Russell. It's too obvious. So they have to do it slower over time. So a lot of times it moves ahead of the rest of the market. So when I see the weekly energy on the Russell giving way to the downside and it's getting burned out, it's down to the 40s. It's maybe got, a little bit further to go, but that tells me that the Russell may be signaling that the rest of the market's going to go down in a similar fashion, and that's where it's headed. It's just obviously got to catch up because the Russell led the way. So that's another just something to notice. Now the Russell will be great to ultimately trade to the put side, right? When it finds that support and has that cup with handle, that's a traditional pattern that's very bullish, right?
Mm-hmm.
So there's an opportunity there, but to me, watching that continue lower, right, and seeing where this market's at, again, all it needs is an excuse, just a push, and often it goes. So
Yeah.
it could be, that CPI is going to be it this week, I think. So,
Yeah.
um,
Hey guys,
anything,
we're
yeah.
going to be here for another couple of minutes. So if you have any questions, if there's anything you want us to address, go ahead and let us know. If you're watching this on a replay later on, then please feel free to write in at support@12minutetrading.com with your question, and we'll cover it the next week. Dave, do you have
I
any
will say
announcements?
this that I like about today, right? And it just could be because this information's coming on deck over the next 2 days, but we've had a really nice reversal today. I mean, the S&P was down 40, 50 points to start the day, and we've come back and gone positive or to even. I don't know how we'll finish the day, but that if we go skyrocketing higher into the final hour, like this thing all of a sudden ends up 30 or 40 handles, that means somebody's got the information and it leaked, and it's it's probably light, sort of thing. So we'll see how this thing ends, but it has done a pretty good job of coming back all day. That's different than the pattern we've been seeing over the last week or two.
That
So
is true. Hey Dave, do you have any announcements for the
yeah, we
viewers?
do. So if you guys are watching or watching on a replay, you'll see we dropped in the chat. Doc and I are doing something that we've never done and that we've been wanting to do. We've been looking for the right partners to help us do this right and everything over the last couple of years, and we finally got this set up. So starting next week, January 20th. We are doing a 5-day replace your income challenge. Doc and I are going live every single evening and taking you through soup to nuts, like how to build a winning cash flow trading business that you can do in 12 minutes or less a day, right? So we're going to peel back the curtain. We're going to show you everything. We're going to go in depth every evening, have Q&A, all of that. We even have a VIP for those that are interested, where we're going to do a lot of extra things with you and stuff. So if you get a chance, go out and check that out. It's at replaceyourinkomechallenge.com. Again, that's replaceyourinkomechallenge.com. It's gonna be an awesome event, guys. We put a lot of work and effort into this. This is the bigger than anything we've ever done before. So look forward to seeing you guys there, and check it out. And if that check out that VIP. We put a lot into that. The value on that thing is crazy. So definitely. And if you have any questions, definitely send us a note and stuff. But replaceyourinkomechallenge.com. So
So yeah, we may
Chalupa man. Look forward to it, man. Look forward to
yeah,
seeing you there.
that'll be awesome. That'll be awesome. Actually, we may not be doing this live stream next week, so I think we'll be that is a market holiday, so I think you guys should all
Yep.
take the day off.
Yep.
However, save the evening for the Replace the Income Challenge, and then after that you can watch the Natty. So
Yeah, and guys, it's free. Like you can join it free and everything. It's if you want to do VIP, it's awesome, but you can join it free. So no excuse to get in this thing and let Doc and I really, like I said, kind of pull back the curtain on. And this is everything, guys. This is from the mental game to the strategies to how to put it together, the rule sets, everything back to front. So we are, leaving no stone unturned on this thing. So pretty exciting.
awesome. Well, thanks everybody. You guys have a great Monday, and we'll see what happens with the PPI tomorrow. Thanks everybody.
Yep.
Take care.
Have a good one. Bye,
Bye
guys.
now. All right. All right. All right.